I think without further ado, we can kick this off. Uwe, thanks for joining. I'm Rafael Kramanian. I'm the founder and partner at Lendity, but also one of the founding members and current vice president of the Swiss Marketplace Lending Association. This is the National Industry Association for Marketplace and Alternative Lenders in Switzerland. Our common goal among us is to build a mature, transparent, and investor-ready lending ecosystem that allows everyone to thrive and to grow. We work and discuss industry challenges, the regulatory concept and situations. And there is an exchange among us on a certain frequent basis. This is part of this educational effort that we do to actually share with the community what's happening and what are the most important topics. Our members include lending platforms, fintech lenders, but also traditional banks such as UBS. And we all have a common thread, which is we building and supporting the lending ecosystem into a data-driven approach and finding ways to make this a very scalable industry in that way. Now, as we all know, the lending business evolved significantly since more or less the global financial crisis. So a combination of two factors that we observed is that banks retreated from some of the verticals, and at the same time, the development of technology allowed for new players to capture this void that was created there. Now, these new players, relatively new, by then now pretty much mature, I would say, have different sort of business models that go through covering different parts of the value chain, can be the purely origination or others until doing everything on balance sheet. Now, irrespective on the business models that we observe, there's always a critical point into this business, which is the funding structure that is going to allow these companies to scale. And this is a topic that looks simple, but as Uwe knows, this is a very complex thing that needs to be taken care of in with the right complexity at the right stage of the business. Now we're seeing a shift into private debt entering this field where traditionally was kept by banks, and in Switzerland this might be even more accentuated since the how to say, when the credit Suisse stop being there in the market in a way, and we're seeing the appetite for private credit among institutional investors also picking up. I think as this webinar is part of that mission, I think we can open it up and discuss this topic with a person that I appreciate a lot, Uwe. I think I had to dig into my emails to see when was the first time we started to discuss, and I had to go very far away. Our first discussion was in 2017, and I think you combine that ability of having very in-depth expertise, but also that ability to articulate the thoughts in a very simple manner that people can understand it. So that's why I thought it would be great to have you here. Thanks for joining us, Uwe.
No, pleasure. Looking forward to it.
Super. Can you? I mean, I thought about introducing you, but who's better than you to tell us
Sure.
what you did? So if you don't mind, share your background with us, please.
Yeah, sure. So as Rafael mentioned, I'm Uwe. As you can see in my background, I'm currently a CFO at LeaseTeq, which is an auto origination platform operating in Switzerland, Austria, and soon to be Germany. Prior to my life at LeaseTeq, I was at Credit Suisse for 3.5 years, where I was in the Swiss unit leading the team of finance business partners for all internal units, including the consumer finance subsidiaries of Credit Suisse, where I also sat on the board of their consumer finance bank Now, for around about 2.5 years. So prior to that, as I think Rafael knows, 2017, I was still at Cembra Money Bank, the biggest independent, publicly listed consumer finance player in Switzerland, where I was responsible for strategy and M&A, where we successfully grew at the time inorganically, did a lot of transactions. The common thread there was always funding. But prior to that, I ran the treasury of Cembra, pre-IPO as well as post-IPO, and encountered all forms of debt, the whole spectrum, all the way from deposits to ABS structures, private, public, and you name it. I've seen it on at least on the DCM side. So I think that gave me, over the years, a pretty good vantage point on at least how institutional grade funding works. And I think in my most recent role, LeaseTeq is a startup. So it has also been a nice learning curve going from, investment grade institutional structures, shifting a little bit to the private credit side, where I think things roughly work the same, but also different. And I think that's an interesting, going to be an interesting discussion point here. Well, that's me in a nutshell.
Super. Thanks for that intro. Very interesting background. Maybe, Uwe, you go behind many years, and if I'm not wrong, even pre-global financial crisis, right? In your expertise in this industry.
So I think what's worthwhile just highlighting, because you mentioned global financial crisis. So as a lot of people know, Cembra Money Bank belonged to GE Capital once upon a time. And for those who know, GE Capital in 2008, as a non-bank financial lender, had a front row seat to funding issues that clogged up the system. So I think in my career, I've encountered three big crises. Credit Suisse being the most recent one, front row seat to that one. The SMB peg removal, where I was treasurer at Cembra. That was the second one. And the first one was the global financial crisis at G Capital. And I think there's a lot of experiences you take away out of all of those exercises.
And that learning, how did you witness that evolution of the lending industry? If you would do the fast forward of the last 20 years, or maybe 15 years, what were the patterns that you observe, and how do you see this business evolving?
Yeah, so I think the irony is that a lot of it repeats itself, in the sense that everybody's used to, since the global financial crisis, and what triggered a little bit already there was non-banks moving in, taking assets off banks' balance sheets, and I think this trend has accelerated post-crisis. And the non-bank financial industry, where I think we're moving around at the moment, on the funding side has accelerated over the past, pre-corona. It really gone completely radically changed who is giving the money. And I think the common thread is how you get the money on the ground hasn't really changed that much from banks. It is more the who the end counterparties are giving the money. So, and I think the common thread is always even a non-bank giving money, big asset managers, private credit, etc. The technology to get the money and transmit the money onto the ground still follows the same blueprint that it did, 10, 15 years ago.
When you say the technology, you mean that the tech stack being used to funnel that?
Yeah, exactly. So the financial technology, I put it that way, ABS securitization fundamentals.
Got it.
That technology, I think, financial technology hasn't dramatically changed. It's more creative than maybe it once was, but the fundamentals are generally the same as they were at the global financial crisis. What has rapidly changed is the depth of where the money is coming from. And I think that's this trend that we see now of, private credit funds, private debt, that's exploded.
And is your comment that things didn't change, inferring that they're ripe for a change, or more like not necessarily, we don't need to reinvent the wheel, this always has been working?
Exactly. I think if we're honest, we don't need to reinvent the wheel. I think a lot of what counterparties expect, whether it's a bank or a big asset manager, it's the same, right? From a borrower perspective, you still have to do roughly the same things that you would have done even if a bank was on the other side. And I think one of the big topics is what often falls between the cracks is that scaling a lending business is, simply put, a function of having the money to lend the money. And if you don't have the money, you can't lend the money. And there's this catch-22.
Yeah, that's the chicken and egg problem we all have.
Exactly. Yep.
Maybe Uwe, can you describe in simple manners what's the full spectrum of a nascent lending business until the most mature ones, larger volumes? What do you see as different stages in a simplified manner?
Mm-hmm.
How are the first lenders lending? What's the source of funding?
Mm-hmm.
And how that evolves?
Yep. So I think, and LeaseTeq is a good example of this. Other lending platforms have followed a similar path. I think, just any lender, no matter, and I've talked in my life to a lot of lenders. It all boils down to two things. Do you have your risk under control? And can you do volumes? Because from the ones deploying money, they're most interested in is it sustainable, and what's the risk profile attached? So I think starting out as a lending platform or an origination platform, that first step is the less sensitivity on what it costs to get the money. Because if you have a model that is sustainable, and then if you have the money, your problem shifts very quickly to, can you generate the volume cost efficiently with no negative bias? And so I think what we've seen is the sensitivity on a business case for a lending platform. If it's so razor thin, meaning you undercut people in the market, it will self-correct and you will blow up. So it is a balancing act between what can I get on the lending side in terms of charging customers and don't have negative bias, and what I can get for the money that I'm borrowing. And in the beginning, the money is always more expensive than it needs to be. But this is simply because those initial funding sources are more risk aggressive than most would be. That's why you're getting the money in the first place.
Which is at the beginning, it's purely equity, right? The way you need to finance is equity or equity-like instruments.
Exactly, correct. But I think this is the catch for the lending business. Any lending business scales with debt because it's a game of leverage. Right? The banks are regulated at how much leverage they need, how much leverage they can do. And effectively, the niche that we all operate in is a leverage game whereby, with the minimum equity that people feel comfortable with, you put the debt on top. But the reality is, again, to scale, you have to do debt, right? So equity will only get you so far in the lending game because the margins are thin. I think that's the other brutal reality of lending. You can only make money between what you charge your customer and what your debt costs you. So I think in the beginning, there's equity to fund your operational business. But there is also a debt element that you need to nail down right in the beginning, because that's how you will scale. The more equity is expensive, all of us know this, and the economics are just very difficult if you don't have debt to scale.
Yeah, I think that initial phase, it's where these new lenders should prove they have a proprietary channel to acquire these customers, positive unit economics, and risk under control, as you said. When is the moment? When do you see the moment that transitions into start bringing debt into that funding mix? And maybe in terms of volumes, it's a good way of describing number of loans. Whatever metric do you think is more realistic?
So I think the issue, and it's just back to the point I mentioned at the beginning, lenders care about risk reward, and risk is very difficult for a startup to prove because risk only kicks in not on day one, but years down the line. And I think depending on which market you're tapping into, that validation of the portfolio quality is extremely important. And the reality is, it is not a good story to sell if you say you've never had any losses. I think encapsulating it, how do you know then that you have good quality because you've never experienced bad, right? So I think as you get bigger, this negative, you almost need to lose money to prove that you can control how much money you're going to lose.
Is that because losing money shows the time history, or also the fact that you didn't leave value on the table and you were not too restrictive in your risk?
Exactly. I think it's the latter, right? It is because when you scale up, no matter how good your risk assessment is, which is the key at the end of the day of any lending business, if the bigger you get, the more diversified a book gets. It's just highly statistically unlikely that you always manage to pick the good ones. It works maybe for the first 10 million, it works maybe even for the first 50. When you start going maybe north of that, and it depends on how big your tickets are, how diversified you are, but a sustainable portfolio, I think at the end of the day, for any lender is diversified. You have losses, but you're generating money somewhere else. So portfolio-wise, you're still healthy. I think that's extremely important in building up, some level from the ground up of how much risk can you take as a business that often falls between the cracks. What often happens is you scale big tickets, you like big tickets because they bring big interest, big revenue. But on the flip side, if you have a 10 million book and 5 million is one counterparty that goes pop, not so great. So I think that evolution is extremely important.
So you need to be able to show that you actually push the gas, and at the same time, at least enough history that matches the life of your assets for 1 or 2 cycles, I'm guessing. Now, what comes next? Once you prove that, what's the funding structure that you see most likely coming in?
So I think the next evolution very quickly becomes like something collateralized. The bigger you get as a startup, your cost of capital is far too expensive to put in the funding structure. So the only asset you have are the assets we're originating, which means you find yourself very quickly in some type of collateralized structure, which is, I think, very often where the fun starts. Because the bigger you get in a collateralized structure, the different classes of investors you start to attract. So, for example, the more debt you take on board, you're going to have one class of investor who says, I only want this type of risk. I'm not willing to take full risk on the whole book. And then you need to find another investor, and then you need to find another investor, and you basically start chopping up a loan into different pieces.
So this is what you're describing is more about getting individual assets and allocating those individual assets to different investors, or we're starting to see a pool of assets being tranched for different investors?
So I think it is very often a pool of assets. that get chopped up, meaning, because what's very difficult is, you buy loan by loan, or you're assigned collateral of loan by loan. But what matters is how this all aggregates into a portfolio at the end of the day. So what you very often see are like borrowing-based facilities where there's a pool of collateral that is supporting money that has been lent. What generally very early on happens is, with a number, you get 100 million worth, or you get 90 million worth of cash against a portfolio of 100 million, which means that this 10 million buffer is, served by a different investor class. But I think the structures, how they generally evolve, is they become collateralized based on the performance of the collateral. You chop up the portfolio and you attract different investors.
Yeah, as I said at the beginning, I think you make it sound very simple, but this is a pretty complex thing. I would like to deep dive on that, but maybe before, if you can mention forward flow, which is funding structure pretty much used in many of our members. So, what is a forward flow, and when that's it kick in, and when you end up maturing from the forward flow?
And I think that's a very, very good point, because in this funding journey, what I think a lot of startups, maybe unintentionally, find themselves in is running, I call it a balance sheet business, meaning the classic bank model. I get money, I earn interest over time, and the more money I get, the more money I lend, but my revenue stream is interest over time. Even though it's a little bit of interest, you effectively do this 100 million times and you get to substantial, bottom line. I think what has now popped up, it has also always existed, but the forward flows have now been used as an instrument from different institutions to put money on the ground, is effectively where a startup is using the balance sheet of somebody else, meaning you're effectively not borrowing money, you are directly originating, such that your value proposition is volume, and you get a fee potentially upfront or a fee over time, but you don't earn your economics are volume driven. They're not a lifetime like interest rate driven. And I think that's the new development that's coming up now. You have different players providing their balance sheet. So effectively, you are originating, that's what forward flow is at the end of the day, originating on somebody else's balance sheet. But I think the key element is, if you are using somebody else's balance sheet, you have to play by their rules. So very often in forward flow agreements, you have eligibility criteria, you have certain triggers around the health of the portfolio to align interests between the one who's bringing the volume and using the other one's balance sheet. It's the classic 2008 issue of moral hazard. The one who's bringing the money, if he doesn't feel the pain of the one who's sitting on the risk, this never ends well. And I think this is generally where the meat is in forward flow agreements, to align interests between the parties.
I think that there's skin on the game component in what you just said, but we also observe the more fintech lending platforms, more maybe catered to non-institutional investors. They don't necessarily have a skin on the game structure, and they originate, keep the servicing, and then do a true sale to these investors. I think as you want to tap that institutional investors, there's no way out of getting that skin on the game. I think it's part of that. And how, from a lender perspective, what's the advantage of having a forward flow agreement, and how can one think about funding diversification and tapping different sources?
Yeah, so I think from a lender perspective, why is generally forward flow attractive? And ironically, banks more so in the EU than in Switzerland are very active in forward flow, simply because it's asset allocation, right? You have effectively you get the benefit of the return of a certain asset class without all of the operational headache, because that's what the startup does, right? In theory. So effectively, the risk return is very attractive in like what LeaseTeq does, for example. We have forward flow agreements where the value proposition is very straightforward. The bank on the other side has excess capital, has excess funding, and wants to deploy it into leasing. But in order for them to get access to leasing, they would have to build up, the operational overhead. So it's an arbitrage between, do they pay me to manage all the operational side and they keep the risk reward on the asset, or do they build it up themselves? And that's why forward flow is very attractive, because you get the benefit of the asset return without any of the operational complexity. That's
Yeah, for the off-taker, I think the value, it's pretty clear. From a lender perspective, why someone wants to have a forward flow? Would you ideally want to keep different sources of funding? Is forward flow compatible with the more, let's
on the
say, SPV
borrower
type of
side.
approaches? Yeah.
So on the borrower side, not lender.
You as a lender getting funds from a
Okay,
loan
good.
lender, yeah, in a way.
Yes.
Yeah,
Yeah.
you would be the borrower in that case. Sorry.
Exactly. So I think it is, and it's a very important point because it highlights, what is the fundamental business model of the player. Meaning the beauty of forward flow is you don't directly hold the credit risk. You get your money up front, and if things go bust, you've got your money up front and you can make a living, right? The downside of it is it's not recurring, or at least not the lion's share of it is recurring. So what it effectively means, and a forward flow model by design is more aligned to like a brokerage. Let's call it brokerage plus. With a bit more skin in the game than a pure brokerage, but it means you live or die with volume, because you have to continue to pump volume, and that gives you a different volatility in your business. If you don't do volume, you don't get income, then it's just a completely different risk profile from the startup perspective. So I think what's important is it is always also from the startup diversification, right? You can live completely off forward flow, but then you need to be very comfortable that you can get volumes that sustain a cost base, even if your volumes dip, right? I think that's extremely important. The other side of the coin is the interest model is recurring. So traditional, like ABS structures, collateralized facilities, if the volume is not there, you have a book that you can rely on to keep you afloat. So I think a combination, it's really business strategy at the end of the day, of what is your profile. Everybody likes the idea of lending platforms that are asset light and just do fees. And on a relative basis, those fees are quite healthy. Sometimes what gets lost in the picture is if you can't do the volume, then you don't have the revenues either. So
that's the flip side. I think I would add one more thing. When you do the forward flow, you keep that client relationship yourself, and hence the recurrence doesn't happen at the whole life of the customer, but the customer is still owned by you. So eventually you could reoccur that revenue at some point.
correct. Exactly.
Which
Correct.
should have some value. And Uwe, when I think a lot of our audience are familiar with forward flow, maybe less on what comes afterwards. What's the option when you start setting up an SPV, a special purpose vehicle, to house these loans? And if you can touch upon when does this start make sense? How does it work? The waterfall, and also the operational complexity and the skin on the game component.
Mhm. So I think the evolution is that, when you get to it's all about size at the end of the day, having a certain minimum scale where effectively it starts to become attractive, and we talk 100 million plus, a portfolio that is churning, that is turning, best case growing. What you very often see is you then start to attract a different investor base. The ones that do the 0 to 50 are very different from the ones that do 50 to 100. And the ones that go 100, we're back to our old friends very often, the banks, very often. And what generally happens is you end up in the securitization space. It doesn't have to be public. There's a very healthy private securitization market. And the fundamentals of this, again, are not different, whereby everybody's taking a different portion of risk, meaning the banks generally will give a lot of money, but take the least risk. And what that means is in tangible numbers, if you have a portfolio of 100 million, you're most likely going to get anywhere, let's call it 80 million from a bank. Now,
80, so 80%.
80. Exactly. Maybe it's a bit lower, maybe depending on the asset class, it's a bit higher, but it's very mathematical. Why? Because this 80 million, and here comes the catch, it's tied to a different type of risk. And how this functions is 100 million book is generating income. The first one who gets paid is the bank because they take the lowest amount of risk. So money, and this is what you alluded to, this magic waterfall, which is a concept that runs through every single securitization that ever existed, is the one at the top is taking the least risk because they give the most money. So what happens then is, where's the other 20, right? You have a book of 100 that needs to be funded. I only get 80. I need to find 20. And what happens is, again, you have now another risk class. You have maybe, we call them mezzanine investors, who take more risk than a bank, but because the bank is there, they operate with leverage. Meaning, a mezzanine investor has a completely different risk profile and risk expectations. So he's willing to take more risk. So what generally happens is a mezzanine investor who approaches a deal very differently to the banks, because the banks always get their money, therefore it's cheap money, but it comes with a lower risk. The mezzanine investors say, okay, I'll give 15 million or 100 million, but I want double the coupon because I'm taking more risk. And why is he taking more risk? Because any money that comes in first pays off the one at the top, and only after they have been paid off does the one below them get the money. And that's where the risk adjustment comes in. In the magic waterfall, it is like the illustration is water flowing down, but if it gets stuck at the top, then it trickles down to the bottom. But from generally these mezzanine investors, they calibrate their risk to a certain portion. So in my math, we have 100, we get 80 from the senior guys, low risk. You get 15 from a mezzanine investor, completely different investor, different requirements, different number crunching, but you're still left with 5 that needs to be funded because you've given out hundreds. And we come now to the last piece in the puzzle, actually in the EU, in EU certified securitization transactions. There's a rule that every originator of loans has to hold at least 5% of what they originate. And the reason for this, Rafael alluded to it, skin in the game. What this effectively means is if money dries up, the waterfall, you don't get the 5, you as an originator, you need to be feeling the pinch.
Yeah, this was mainly as a consequence of the risk retention rule was consequence of the subprime mortgages, right? So all the critics go at that, and the alignment is very strong now. Maybe to rephrase everything, Uwe, is on the funding structure, we have 100 that we need to obtain. Let's say the senior 80%, the one having least risk, but also the cheapest cost of funding will come from banks. Then there's other specific players on that mezzanine one, and then there's a wish that the originator, to some extent, has that 5% as skin on the game. Uwe, maybe the why are banks active there? Is this mainly because these are rated securitizations, or they can replicate a similar cost of funding for themselves as if this were a rated securitization? Is this a regulatory reason?
So exactly, effectively by taking less risk, they can be rated externally 9 times out of 10 in private debt. They're not. But the bank, what is the bank doing? They're effectively running a rating model. And generally, for them to give 80, they need to get to, let's call it A minus investment grade rating. So that they can say, aha, this has lower capital requirements against it because it's
the risk-weighted asset of that exposure is aligned into an A and so on.
Exactly, correct.
So you set the 100 million mark to start making sure the economics can work for a private securitization. When does a rated one start making sense?
So an externally rated one.
Externally rated one, correct.
And generally the path from, a bilateral, let's call it private securitization, to the holy grail of a public securitization. I think there the jump is, I think let's talk EU rather than Switzerland. ABS Switzerland public is a bit dead these days. We're talking at 200, 250. That's like and importantly, I think is a portfolio that also churns. So you can have amortizing deals where the principal just goes down, but that 200, 250 is like the minimum threshold for a public deal. And external rating agencies, they effectively do generally what the banks would have done or do in a private securitization to get to a public rating of whatever it is. And I think importantly, in the public space, what is often misunderstood is you have the same mechanics as you do in the private. You have tranches. And the big ticket numbers, when you see, auto manufacturers or big ABS deals, if you're selling a book of 250, you have maybe 200 of AAAs or super secure, and it's the same logic. High rating, low cost. And then you have the next tranche of the mezzanine, different investor base, nice rating on it, but maybe it's, I don't know, triple B minus, right? But that has then a higher cost associated with it. And then you have the remainder, which is the risk retention, which you have to fund anyway. So the weighted average cost of this is what you end up paying.
It comes across as there's a limited, let's say, magic to be done on the funding side. Things are pretty standardized. And as you said, didn't evolve in the recipe on how this has been done. I would like to double down on a private securitization, which is mainly the aspirational path some Swiss ultimate lenders can aspire to. And if we want to do 100 million securitization, we need a bank that can actually take that 80 million. What is a realistic volume that originator should have done already kicking off those discussions? Is 1 cycle, 2 cycle, 5 years of history, 3 years of history? What do you see as the minimum threshold to start allocating time to that funding source?
Yeah, so I think it is a lot about, there's less an absolute number and more the plausibility of the story. So I think, and importantly, we say banks, but it need not be banks, right? You have asset managers who also play where a bank would have played. They take up the 80. So the roles can change in the stack, but it is more important how plausible the end goal is. Meaning, if you've built 100 million book over 10 years, and you're saying my story is, I'm going to stay at 100 million. Okay. From a lender's perspective, so the ones providing the money, what does that actually mean? For the one at the top, it means I'm going to deploy 80 million. Okay. I get it's low risk, low reward. Not very nice. Like, it's not juicy. And then the one below them, they deploy even less, right? So I think the story is 10 times more important. Case in point, LeaseTeq. We started from zero. And, like most startups, we said we're going to be in 500 in 2 years, right? But the track record of efficient cost of acquisition and the plausibility of the origination channels, I think that's extremely important to get that growth trajectory. That's what they're buying into.
So when you say the story, you're referring more to the plausibility of the business itself, its business model,
Yes.
the reason why they will acquire customers sustainably at solid unit economics.
Exactly.
At the end, I think it all comes down into that. And despite the fact that any lending startup faces the traditional challenges of a normal startup, and on top of that, the lending complexity, at the end is the same. Finding
Yes.
your client, finding that, having that angle, and make you that differentiation. I think this is very interesting to see. How do you see the Swiss market, Uwe? Maybe a few comments on the Swiss market. What do you see as potentially evolving? How do you feel about it?
So I think there's a lot of interesting developments in the Swiss market. So I think as a consequence of Credit Suisse maybe pulling back on things that others didn't do, others are moving in, especially international players. And I think in the public space, you have big international lenders who do securitization transactions in Switzerland. Barclays is very active. So it is very often the market is there. There's also, I think, a lot of interest in the macros of Switzerland are generally very healthy relative to other European countries. So there is pools of money, substantial money that can be deployed. In Switzerland itself, domestic Swiss lenders, I hate to say it, it's tough, very tough. As a consequence, I think, of the fallout of Credit Suisse. The more creative funding structures are just not what domestic lenders do. It's not their sweet spot. So the good news is, there is a lot of appetite cross-border from international lenders because Swiss macros are healthy. The base FX risk, etc., can be hedged out. So the economics work quite nice.
Why do you think the Swiss players are not active? Is it a volume thing? Is it a skill set or knowledge on the space?
So I think what's interesting is a lot of the time, the more complex the structures get, it's historically you don't build these structures out of Switzerland. 9 times out of 10, you have to deal with Frankfurt, you have to deal with London, you have to deal with where this heavy skill set is to run effectively what rating agencies would run anyway. Is not sitting here, right? Now that's not per se bad, but case in point, there are public ABS transactions out there in the market. It's very rare to see one running under Swiss law. So the whole, I think things can be done, right? And I think it's important to distinguish at scale, right? Yes, we've all seen the transactions at 100 million that some cantonal bank has done. Yes. But 100, 200, 300, 400, you know, and they get very rare. And I think the Swiss market has not necessarily, or the incumbents, I'll put it that way, have not exploited, you know, all the weird and wacky financial technology that is going on.
Yeah, I think there's this combination of maybe the deals not happening here and the expertise not being sitting here, but also I think the shift into thinking about the capital stack strategy is going everywhere. And maybe you followed the recent securitization that Meta did also with some other private lenders. Very long-term investments into data centers that require 29 billion funding, and all has been done through non-balance sheet structures. Do you think this trend that we see very large pools of money that are non-bank lenders going into the main economy, do you think this trend is here to stay? Will it grow? What do you think about this?
So
the Kimcos, the Apollos, all these players.
So I think personally, yes, this is here to stay. And I think the reason why is exactly what you mentioned at the beginning, right? There is a hunt for yield globally. The Apollos, the KKRs, all of these guys have, you know, super cheap insurance money. And this is exactly what Apollo and everybody else is doing, is, you know, that money needs to find a home, right? It needs to find a yield. The challenge is there is more money available than investable places to put it, which then forces, you know, this trend exactly of what we're seeing, where, you know, you have Apollo de facto lending to Meta on a fancy securitized basis, but it is this hunt for yield. And this is not going away. Traditionally, it's been the banks who have been pushing on this. And it is this capital stack that is shifting. The banks used to eat more of the capital stack. Now they're drying up in the they're still there. They're drying up in the capital stack, but effectively, you know, there's different players plugging those holes. So I think this is a trend that is just going to stay 100%.
Yeah, we saw already movements this year in the Swiss market as well. Both Swiss Life and Vaudoise allocating capital to actually do a lot of SME lending. And I think I agree with you. I think this is here to stay. We do have a few questions in the room. Actually, we have one. I'm going to read it out loud. How do you assess the power of banks to determine price levels? I.e., if a dominant player starts increasing its margins, all others follow.
Yeah, so I think this is, and it's a reasonably competitive. I think at least where the banks paid, there is, if you look exclusively at Switzerland, there's one big bank running around and no longer two. So there is a bit of you know, price power that can be exercised there, which is a challenge. But I think the bigger the structure gets, you know, it doesn't move that much, like 1% backwards forwards. So when you're small, you're just a taker, right? When you're bigger, you have more possibility to play different lenders off against each other, where the pricing, it narrows into a corridor. So, but it's a function of size, unfortunately. That's the reality.
Another question that came is, we hosted a conference in September in Basel, and there was a lot of institutional investors saying and expressing their interest about marketplace lending, but yet many people are hesitating to actually invest. What do you think, Uwe, is the principal reason that the institutional investor tap is not flowing into marketplace lending so far in Switzerland?
So I think a lot of it is, one thing is track record, getting comfortable with, the asset class. I think there is one marketplace lender that does a good job in publishing its historical performance over the past 10 years, which helps build that comfort level on performance. But I think that is very difficult for new entrants to prove that. They have the risk under control. That's the biggest issue, I think, in getting that institutional money deployed is it still going to be there? A, the one originating and servicing, and B, the portfolio, is it sustainable and resilient?
Yeah. Do you think and observe that some of these investors are also interested in taking an equity participation in these originators? Is that a way to solve that issue?
It is partially, but I think it only gets you so far, right? It gets you that first maybe 0 to 50, and then you're just forced into speaking to more and more institutionals, more and more players to get more and more money. I think as a first step, yes, but a lot of it is, dare I say it, the herd mentality, right? If one jumps in, then another, then everybody thinks they need to jump in.
Yeah.
Soft and fuzzy things play a bigger role than hard numbers in the beginning.
Super, Uwe. As we getting to an end, are there any resources that you would point if people would like to learn more about these more sophisticated funding structures?
Yeah, so I think it sounds silly, but there are a lot of one decent website is globalcapital.com, where it's a lot of the securitization industry happens in the shadows, right? You don't see it a lot, especially the private transactions. I think Global Capital does a pretty good job of assessing what is going on across European and also global securitization. But I think that's the most obvious one. But yeah.
Super. I'm just sharing this in the chat. Great. I think we, as you know, I could stay hours discussing this topic. It's also very something that we are passionate about as well. And but we're coming here now to an end, Uwe.
Mm-hmm.
This has been great. I hope people can learn from what we discussed, and I'm sure if there's someone who would like to know more, I'm sensing that you would be open to discuss
Yeah, no,
with them.
definitely. I'm always open. So I think everybody has my details from this. So more than happy for a chat.
Great. Thank you very much, Uwe.
Perfect. Thanks a lot, everyone. Take care.